Welcome to Concrete Conversations, the Indian real estate podcast. Amongst emerging trends within the last 5 years, fractional ownership has become a popular concept to democratize real estate ownership for investors in India. According to a recent report from Knight Frank, the market for fractional ownership in India has been growing at an annualized rate of 10.5% and is projected to grow from $5.4 billion in 2020 to $8.9 billion in 2025. As this space grows, SEBI has recently approved the framework for regulations of medium, small, and micro REITs, with the aim of formalizing this sector to protect investors and standardize best practices. To talk to us about these regulations, the fractional investment process, and the future of such MSM REITs, we have with us today the founder and CEO of the fractional ownership platform hBits, Mr. Shiv Parekh. With a BS in engineering physics from Stanford University and an MBA from Harvard Business School, Mr. Parekh is no stranger to real estate entrepreneurship, having founded WorkLoft in 2015 as one of India's first few co-working players. He also has experience working with Stanford Management Company, Citi, and Raycon Infrastructure. In 2019, he founded hBits as one of the first players in the fractional ownership space in India. Today, hBits has an AUM of approximately 200 crore INR from their 9 existing properties and more than 50,000 registered users on their platform. So stay tuned as we explore the future of MSM REITs in India. Shiv, thank you so much for joining us on Concrete Conversations. How are you doing? How is your evening in Mumbai going so far?
Great. Thanks a lot for having me here, Yash and Akshay. No, evening is good. Just spent a car ride. I had a meeting in Juhu, so
Right.
hour and a half in the car. But is what it is.
Yeah. Shiv, we like to start off every conversation with each of our guests by learning about their career journey and understanding how they got to where they are today. And what motivates them to, work in the space they're working in today. So, with that in mind, could you tell us about your career journey and how you got to where you are with hBits?
Yeah, sure. So obviously, I'm born and brought up in Mumbai, and lived here till I was 16. Post that, in fact, spent a couple of years in the UK. Went to boarding school there, and then did my undergrad at Stanford. I studied physics. But I knew that I didn't want to have a career in physics. It was out of pure interest. And then I worked very briefly in finance in New York. But I quickly realized that I, had the entrepreneurship bug. Didn't really enjoy the investment banking life. So moved back to India very quickly after. And initially I worked with my father, who's into commercial real estate development.
Right.
So his business is into constructing these commercial complexes, leasing it out to MNC tenants. So obviously got an exposure to that industry, understood everything from development, approvals, leasing, finance, and then and obviously built up a network in the industry as well. And then in 2015, I decided to set up one of the first few co-working spaces in the country. In fact.
Oh,
So at that
right.
time, there was only Office had one center, 91 Springboard had another center, and there was no one else.
Right.
So set that one center up. It did, had its initial challenges, but then it did pretty well. But then decided to go do my MBA at Harvard instead of expanding the co-working business into a larger business. And then by the time I come back from Harvard, the co-working landscape has completely changed. There are 300 different players. WeWork had entered the market. So it was a completely different environment. And what I observed is a little bit of a price war in the co-working industry. So decided not to pursue that business anymore. Although, right now there are 4 co-working centers. It's kind of running on autopilot. It's like a small business, but decided not to pursue that. So I was looking at various different ideas, and that's when kind of I saw from a real estate. So I like kind of figured out this idea, and I saw basically from a real estate developer's perspective first. Especially a commercial real estate developers, there are only 2 ways to exit. You either lease out your full building and then sell it to a fund. The fund could be Brookfield, Blackstone, depending on the size of the asset, or you sell floor by floor to ultra HNI investors, where the minimum ticket size is still 20, 30, 50 crore to own these assets that are already rented out. And these are very attractive asset classes to own. You will get 8 to 9% rental yield. That's backed by long-term contracts with MNC tenants, and along with appreciation, you can make a 15% IRR, and minimum downside risk because it's a hard asset.
Right.
But obviously, retail investors didn't have access to this asset class. Minimum 20, 30 crore to invest. And from a developer, it's a great exit option. So I thought, why can't retail investors own a share in the property and make the returns associated with owning the full property? And the vision, obviously, was to create the stock market for real estate, right? The same way that one can own a share in a Reliance stock or a Tata stock, why can't one own a share in a building in, say, a BKC or a Gurgaon? Why is that not possible? So that's kind of the genesis of the concept, and a little bit on my background.
Right. But I think that's perfect to hear about. I think we can attest to the fact that there's been a supernova of startups coming into the co-working space. We've, I think, interviewed a fair chunk of them on this podcast as well. We've also had a few players talk to us about fractional ownership, and we know that's sort of the genesis of what you're talking about with hBits as well. So with that in mind, could you sort of give us a breakdown on one sort of, we can start with talking about like how the establishment of hBits came about, and the process of like founding fractional ownership within the Mumbai market, or how you sort of took basically the primary and secondary research into figuring out where in this fractional ownership space you would like to work, where you'd like to found your niche.
Yeah, so see, I mean, when I started, and so that's where I thought of the concept and seemed exciting. And to be honest, then I was looking at 2-3 different ideas, both real estate related and non-real estate related, and did a little bit of high level research across all the concepts. And then this one, the few business ideas that I had, and this one excited me the most because it was a combination of real estate, which I already knew. It was a combination of finance and numbers, which I've always been maths, and I studied physics. I've always enjoyed that. And it had a tech component to it, which I think everyone in our generation enjoys. It's just we're brought up in tech.
Right.
So it is intersection of these 3 different fields that I had an interest in. So I said, okay, let's do this. And at that point, I looked it up, and I found there's only one other Indian player that was operating, and they were a Bangalore-based player.
Right.
And I thought, obviously early days, market is young, so let's kickstart. And to be honest, how I started out, it was, there's like an interesting story, right? So of the early days of hBits, right? Because sure, I came from a good pedigree in terms of education, and can create a nice financial model, can create a nice presentation, right? And I decided that okay, this is, I found a small 7 to 8 crore asset, which is I wanted something small to test out the market with. And did a tenant analysis, good building, etc. So checked all the boxes, and it was I wanted something small to start off with, good numbers, good capital value, good rental yield. And at that point, I had a team of about 4 people, including myself. I had one person in digital marketing, right, who we outsourced creating the landing page of the website, one person in digital marketing, one junior guy, like one guy who had like 1 year of experience in sales, and then another guy who had about 5 to 6 years of experience and who actually worked in wealth management. He'd come from Aditya Birla, so he was pretty decent at sales. 4 or 5 years experience. So he actually worked in wealth management sales. So that was the initial team of 4, including myself, that was there. And we narrowed down on this asset. I was doing the asset analysis, financial model, all of that. I was preparing that myself. And so what I was saying is, like, you think that initially and early on sales is going to be easy, or not easy, but you think it's not going to be as challenging as it is. And and the story is that we're sitting in a conference room, glass conference room. I say glass because we needed, basically I wrote down 1 to 30 on this with a highlighter, with a marker. And I said we need 30 investors of 25 lakh each, in the next 30 days, let's get an investor for every day of the month. And by the end of 30 days, we had 0 investors. So I think what you realize is that because in a way I had a co-working venture, but it was like one co-working center, and you're selling seats for 7,000, 8,000 rupees a month with no lock-in. So the entry barrier, or from a customer perspective, it's not that much of a cost. But here you're taking 25 lakh of someone's hard-earned money in a new concept. And in a new business with an entrepreneur who at that time was just 26. So the trust component was very low. Even though the product was good, which is why the business is doing decently well today. The business model is doing decently well today. But at that point, no one was willing to trust. Even though all the parameters checked, there were questions like, okay, what if hBits goes bankrupt? What if, who are you? What do you know about property? And even though I had the real estate background, so it still made a difference. And I think eventually, obviously, even though I had 2 salespeople, ultimately to close each and every sale at that stage, I had to be there. And then after a few months, we finally, got over the line and closed that first property.
Right. I think you're highlighting something that obviously stands out, and that's that people always have a lot of questions and are not very keen to commit very fast when they're talking about their own money.
Yeah, exactly.
But I think you're also highlighting something interesting, because you're talking about, when you first start out, I guess with any business, and you have to find your customer and they sort of have to trust you. So with fractional ownership, you're talking about a ticket size of 25 lakhs. You talked about hard-earned money. Still a lot of trust in there. And I think that transitions to something that we were keen to ask you about very well. That is the SEBI regulations that are surrounding the fractional ownership space, surrounding the real estate private investment space at this point in time. So obviously, there have been several layers to the regulations that are being discussed with SEBI, between the industry and SEBI. Can you walk us through some of the intended changes with these regulations, and how do you think they will impact both the trust and the investment in the sector as well?
Yeah, so absolutely. So in fact, we've been in touch with SEBI since last year. Right. So I think what's very positive to learn as someone who, obviously still early on in the career, is that, government regulators are taking a very proactive approach, and they're looking and seeking out industry feedback. So one, highly appreciated that. And then they came up with a consultation paper in May. And I think, firstly, just in terms of headline, I think very, very positive towards the industry. And really appreciate the route that the regulator is taking now, in which they're looking at industry feedback, they're looking at what works, they're looking at the rationale for why such an industry should exist, what economic value it provides to the economy. At the same time, obviously, SEBI's main mandate is in investor protection, so ensuring that investors are protected. So I think that's a great positive in terms of high levels of the regulation. They're obviously calling it MSM REIT, which I think is a great name, medium, small, and micro REIT. And in terms of structure, they've kind of envisioned it similar to the REIT structure, in that there's going to be a trust. The units of the trust will be listed. And then there's specific schemes of the trust, and each scheme would represent one specific asset that you're investing in. So the real essence of fractional ownership, where you can pick and choose which asset you're investing in, is maintained, right? A REIT, the traditional REIT, basket of assets similar to a mutual fund,
right?
While this more similar to a stock. So that essence is the main thing that SEBI has maintained. I think that's great at a high level from a structural perspective. They have certain restrictions on size of the asset, saying between 20 to 500 CR, which makes sense because more than 500 CR is a REIT, the traditional REIT.
Right.
Less than 20, you do get depending asset by asset, but the number of quality assets less than 20 CR certainly reduces. They've proposed only rented out assets, only leased out assets in their consultation paper, which request to SEBI will be and has been that permit under construction as well. But my understanding, or rather my hope, is that they'll first do this as trust is built in the industry. They'd permit under construction assets as well. they've suggested 10 lakh minimum ticket size, which I think is good in the sense it's a good starting point, right? We currently have a minimum ticket size of 25 lakh. So 10 lakh. And idea is obviously to democratize it for more people to have access to it. So 10 lakh is great. And again, the same way, the hope is that the same way it reduced the minimum ticket size in REITs, as trust is built, the minimum ticket size would reduce further as well.
Right.
They have certain criteria for net worth requirement of the investment manager slash sponsor. I think if I recollect now, it's 10 crore liquid net worth and 20 crore total net worth. Which, little high, but on the flip side, I feel that, okay, it's fair because you only want credible players to partake. They have certain requirements of expertise of the people running the show, which I think very relevant and very required. The major thing that we request them to reduce, and which I think doesn't make sense given how the industry is structured, is they've mandated a 15% requirement of investment by the sponsor slash investment manager slash the platform being us.
Right.
And I think my understanding is that they've taken this from the REIT regulation, the traditional REIT regulation. But I think there's one major difference in essence between the traditional REIT model and our model, right? In the traditional REIT model, if you look at the 3 or now 4 listed REITs, if you talk about the retail REIT as well, the sellers of the assets, the developer and the seller of the asset is the same as the investment manager and the sponsor. So, for the person who's creating the REIT, they just have to liquidate the asset less. Instead of liquidating 100%, they liquidate 85%. But for us, it's not our assets that we're listing on the platform. Right? We are listing third-party assets. So for a asset-light model like ours, requiring 15% invested at 15% odd IRR is not the best use of capital, or 15%, 18%, that you get in these assets in terms of IRR is not somewhere where a asset-light model would want to invest their funds into. So that request is definitely there to reduce that ticket size, that amount that SEBI is mandated as skin in the game.
Right.
So these are a few of the major points in this regulation.
To follow up from that, now that you've kind of given us a sort of high-level summary of the different types of pain points or touch points that are being addressed in this regulation, I wanted to follow up on the skin in the game point that you were talking about. On one hand, we're talking about democratizing this by reducing ticket size and allowing more access in terms of assets and investors available, for this sort of vehicle. So do you think the skin in the game kind of also hinders scaling a little bit? Because again, like going from a platform to having mandated stake in each venture or each property that you're launching, does that restrict the level, the ability of the platform, for example, to scale as well?
No, I think it definitely does, right? Because if I want to do 1,000 crore in AUM and have to invest 150 crore in all the properties, it's a very different model, right? Even in an AIF, you're allowed to put even as low as 5 crore. Your AIF can be as large as you want. So that definitely reduces the ability to scale. But my understanding, I don't want to be too. My understanding, and given on, spoken to SEBI, etc. My understanding is that they want this model to work. They want this, business to work. This business model. So the hope obviously is that I think they probably didn't think, they didn't recognize this point, which is why they have this great process of industry feedback. And I'm sure most industry participants would have given them this feedback, that it won't help the business model. It might severely hamper the growth of the business model with this specific clause. But my understanding is that they'll definitely they'll reduce the skin in the game requirement.
Right. And another thought I wanted to another follow up I had basically here was, what was SEBI's thought process behind coming in at this point? Well, obviously investor protection is the primary goal of SEBI, but was the feeling like that this market is now large enough or it poised well for regulation to come and standardize things so that it can expand and grow more and become a more popular model?
Yeah, I think that's exactly what it is, right? If you read the preamble of the consultation paper, where they touch upon, how these concepts have, mushroomed outside India. And actually, mushroom is the wrong word because they've dramatically scaled outside India.
Right.
And then also the kind of access that you're providing to investors in an asset class that's very secure, right? Because right now in the paper they're talking about constructed assets, right? So these assets, OCs received, tenants are already in place. Generally, your tenants are the likes of, I don't know, some of our tenants are ICICI Bank or Man,
Right.
which is a French MNC. So great tenants. Compared to equity, your downside risk is very minimal. Your downside risk is you might not make as much appreciation as you thought you would have, but your principal is pretty much safe, right? So very secure asset class, and on the other side, you're providing a lot of value to developers who don't have much exit options. So you're allowing them to access capital markets in a way that they couldn't have earlier. Which allows developers to then take the funds that they free up and build new buildings, which is what developers should be doing.
Right.
Yeah.
And I think that brings us to another kind of angle that we wanted to explore in all of this, which was, the asset classes. So, like you said, from what we've seen till now, fractional ownership, it's pretty much been grade A rented out commercial office spaces and IT parks at the most. And we've also seen some of the players look at warehousing, right, as
Yep.
potential assets to fractionalize. So, do you think these regulations will have an impact on different assets potentially, or different asset classes that could be brought into this model?
So I mean, in terms of regulation, obviously it's going to widen the scope of the industry. So in that sense, a lot more asset classes will come under this fractional ownership model. But I think that's something that we are looking. For example, that's something we are looking at anyways. So when we look at assets, we don't restrict ourselves to just offices. Like you mentioned, warehouses is something that we've keenly looked at. We're also looking at data centers, schools, hospitals, student housing. Basically, to be honest, any rent generating asset that has long term contracts with grade A tenants and good yields. So to be honest, in today's market, anything except for residential, because residential you only get 2-3 maximum 4% yields.
Right.
But I mean, for example, schools is a very attractive proposition because you get 30-year
Right,
leases.
right.
Right, and very sticky as a tenant. I guess the only difference is that the office market in itself is just bigger, so that's why you've seen just more office assets. But that's not to say that we for example are keenly exploring other assets, and we're evaluating other asset classes. And then that's just real estate. I think eventually you can move this to infra as well, right? Solar farms, wind farms, schools.
Right.
Solar farms, wind farms, roads. Where you again have 30-year contracts. The only difference in those is that it's not an appreciating asset. There's a terminal value to that asset.
Right.
Shiv, I think that easily transitions to another touch point that we thought would be interesting to explore here. We wanted to talk to you about the various stages of the asset management process, right? So you're talking about how this fractional ownership space, this investment space can be applied to different asset classes. So at the very onset, can you talk to us about the assessment of the property, the acquisition of the property, how that works through an hBits lens?
No, I think, by the way, this is the most important piece of any, ideally any real estate fractional ownership player, because ultimately that's the product that investors are investing in. So I think for us, this is the most important piece of the puzzle to ensure that they're good investments at the end of the day. And the way we think about it is there are 3 different pieces to it, and then within that, further points. But high level, it's acquisition, it's management, and then it's exit. So in terms of acquisition, again, within acquisition, there are kind of few different levels. One is the sourcing of the asset. So you have to ensure that you source enough assets. Any asset that comes in the country lands on our table immediately. That's obviously the end goal. And that's one is through having a wide network of brokers, channel partners, your IPCs, and now given the brand that we have, we also have developers that reach out to us directly. So just to give an example, before we launched our last asset, which was overall about 200 CR, we would have sourced 20,000 crore worth of assets. So
Wow.
that's kind of what we try to do. So that's one part of it. And part of that obviously then being maintaining good relations with channel partners and then giving good feedback back to the market,
Right.
that even if we do reject a property, what the reason for that rejection was.
Right.
So that's the first part. And only if you source a large enough number of assets, you'll be able to acquire the best assets. And sorry, other than that, there's also timely sourcing. So ideally, we want
Right.
the situation that as soon as the asset hits the market, it comes to our table.
Okay.
Right. So that speed of sourcing also is very important.
If I may just jump in and ask you there, so you talked about maintaining relationship with channel partners. Does relationships with developers also aid you in that speed that you're talking
Yeah,
about?
100%. It definitely aids us, because then sometimes the asset comes to us directly. So we have our team that's constantly in touch with at least IPCs once a week, certain developers once every few weeks. Just and it's sometimes it's also, you might not know, it's not with a specific agenda in mind. It's just that
Right.
we're in the industry, we're going to be in the industry together for the next 30, 40, 50 years. So
Right.
that's very important from a sourcing perspective. So that's the first level. Then comes the evaluation component. So in
Right.
terms of evaluation, we're very particular in terms of the parameters that we look at. So just a high level, building quality, very important. Right, quality of construction. Look at things like smart building, LEED certification. So we
Right.
look at all of that. We look at tenant quality, the tenant that's occupying that property. You look at, and you study the financials of the tenant, etc. We'd even go to the level studying the bank statement of the current owner to ensure the rents have come on time.
Right.
Then we look at the strength of the leave-in license agreement between the current leave-in license agreement, which will talk about your lock-in, your security deposit, a lot of other clauses as well. You look at you take a call on that micro market, looking at the vacancy and occupancy of that micro market. And then you look at the capital value and the rental value of your asset vis-a-vis the micro market in that building, and we ensure that we are lower, so that
Right.
we're getting it at lower than market prices. So that's kind of few of the high level parameters that we evaluated across before putting an offer. And then obviously there's a negotiation piece, and then there's the post term sheet evaluation, which is your legal due diligence, technical due diligence, ensuring all the approvals are in place,
Right.
ensuring property tax has been paid on time. Legal due diligence, we work with tier 1 law firms. We work with Shardul to do that due diligence. So that's kind of at a high level, that's end to end the whole asset evaluation process.
Perfect. So now that you've taken us through the asset evaluation and acquisition criteria,
Acquisition,
right?
yeah.
That leaves pretty much management and exit. So if you could tell us the rest about that.
Yeah. So in terms of management, obviously, see, there are two kinds of in property management. I'd say there are two kinds of or two subsets of property management. One is facility management, and the other is like lease or tenant management. So in terms of facility management, if we acquire just a unit within the building, then you just have to pay your CAM charges to the society,
Right.
and ensure there's a good facility manager in place. And even when we look at full buildings, we mostly just appoint an IPC to facility manage the building, and then ensure the right process is in place. But the real value add, I think, is in terms of the lease management. Right, so ensuring the rent is collected on time. If there are any hindrances to the tenant, then ensuring that those are dealt with swiftly. And then comes the piece where if the tenant is looking to lease, then the ability to leave, then the ability to idly negotiate and convince the tenant to stay, or release the property. So just to give a few examples, during COVID, we had 100% collection in rent, 0% delay.
Wow.
And I think that's due to 2 or 3 factors. One is quality of tenant. Just ensuring that these are all grade A tenants. And if you notice, all the large companies did even better during COVID. So they all had the ability to pay. Right, and then other is they have a very strong contract in place. And third is obviously good negotiating leverage in terms of having that confidence to say that, okay, even if you leave, I'm able to release the property, and also showing logic by saying that your cost of real estate is basically generally less than 5% of your cost of manpower. So why are you trying to do this at this stage.
Right.
And so that's part of it. Another part is, because of the background in real estate, we have great connect with the IPCs, as well as HR heads, admin heads of a lot of these MNCs.
Right.
So if one tenant leaves, we know who's kind of interested in that location, that micro market. So a lot of that is where that lease management comes into play.
Yeah, and I think just to drill into the lease management a little better, obviously you talked about pre-leased assets being ideal in many situations. I understand that under construction obviously gives you the chance to get a better price. And then is there any sort of nuance to how lease renewals are managed, or how tenant change turnovers managed for leases, and what stage does tenant turnover get brought up in that phase life cycle of the lease?
So in terms of when we look to enter the asset, ideally it will be the start of either the lease or the renewal, because then that's like the maximum left on lock-in. So that's the ideal time. And in fact, that's a very important point that we look at. We look at the tenant's intent for being in that location and in that building. We try and analyze that. We speak to the tenant as well before picking up the asset. What the rationale is. So for instance, one of our properties, they've been there this is their third renewal, so it's their 11th year. Or when we acquired it, it's their 11th year. Now it'll be their 13th year, and they have a lab over there. So there's no real reason for them to leave. So you look at that rationale. If a company has generally been there for a long period of time, and the employee base is coming from that pin code generally, then unless there's like a either larger organization consolidation or restructuring or downsizing, it's very unlikely for a tenant to relocate, or if their building is deteriorating in quality. So generally those are the reasons for a tenant to vacate. So we try and ensure and mitigate that even before picking up the asset. And then in terms of releasing, I think that's where that industry knowledge, that what tenant is moving where, who is consolidating. So one asset that we're evaluating right now, for instance, and I don't want to disclose it right now, but basically I got news that they're consolidating in Navi Mumbai, and this tenant is located in Mumbai. So it's like, I'm not sure whether we want to take that property or not.
Right.
So those are the kind of things that we would look at. And then in terms of when the tenant vacates, that's why we ensure the rental value is below the market value, so that even if I wanted to get a little bit lower than market value, the yield to my investor is not affected.
Understood.
Yeah.
Right. And I guess this leaves the last part in this entire chain, which is the exit. And this is something that I wanted to clarify with you, because there is variance in terms of exit policies and the thought process behind exits also in fractional when it comes to the operators, right? There is a little bit of leeway in terms of how that is operated. So given the fractionalized nature of these properties that you're managing, how are exits decided firstly, and on what basis are they decided? Because like you say, there is a kind of quasi fixed income element to this, where there is a yield. So at what point is that decision made, and how do you evaluate that?
So firstly, we are one of the few players that we've exited an asset ourselves at 17.5% IRR. So that's one thing that we tell our investors. There are two ways in which one can exit. One is we exit the full asset in a 4 to 6 year time horizon. And the way that works is 75. We will obviously get the offer, and then 75% investors agree, and they exit the asset at that point in time.
Right.
Other is one can exit their share on the platform at any point in time that we want. We do a yearly valuation to get some sort of sense of what the asset valuation should be. But then obviously investors are free to decide whether they want to exit at that valuation, or they want to try and be a little bit more aggressive, or they're in need of funds and give it at a discount. But so far, anyone who's wanted to exit at the secondary level has been able to. Generally within 30 to 45 days, one is able to exit their share, is what we've seen. Predominantly, people have wanted to exit because they have some fund requirement, either a family emergency, medical requirement. Son is going for education.
Right.
So those are the reasons why someone has wanted to exit, and we've been able to facilitate it for them to another buyer on the platform.
Right.
Right.
Perfect. So, the kind of other big chunk that we wanted to, or the other big topic that we wanted to go over with you was AIFs, right? Because
Right.
it's something that you mentioned before as well. And now we're sort of starting to see this distinction, given the SEBI regulations, that fractional is moving towards MSM REITs, and then
Yeah.
AIFs are coming up as a distinct product. So, with that in mind, I wanted to ask you why AIFs. Firstly, because Cat 2 AIFs seem to be very popular in terms of the choice of vehicle. And secondly, is this something that will grow in parallel? And it's just that it's different products for different niches of the market.
Yeah, so it's definitely the second. It's definitely the latter, that it's that different products for different niches, and they will grow in parallel. I think AIF is a vehicle that permits you to, as a fund manager, have flexibility to invest that capital as to at that point in time what you see fit. So obviously there's a difference, right? In fractional, you close the asset first and then you go fundraise.
Right.
While in AIF, you fundraise first on the credibility of you as a fund manager and then deploy the capital. So that's kind of high level the major difference. And the other is that in AIF, you can and we are investing 50 to 60% in under construction properties,
Right.
which is obviously where you get higher risk, higher return. So in the
Right.
AIF, we're expecting 18 to 22% IRRs. AIF will also add leverage. In terms of source of capital, you're targeting capital where family offices, larger institutions, and also where someone wants to not think about what the various properties they're investing in, but just trust us as a fund manager. So that's
Right.
where the AIF has come from.
Right. We're speaking of AIFs and fractional ownership. When you talk about these subjects, you're typically talking about investing in grade A assets in developed cities. But we thought it might be an interesting spin to ask an expert on the chances. We talked about the IRRs, but chances for outperforming grade A asset or rather saturated city returns by expanding acquisitions to tier 2 and tier 3 markets. Do you think that's something that the industry will see going down the line, either soon or in the long term? And if it was to happen, what kind of regulations would drive investment to those markets, in your opinion?
Yeah. So will it happen? I think yes, 100%. A lot of investor interest is in these cities. A couple of people from our team went to Gujarat. They toured Baroda, Surat, and Ahmedabad, and a lot of them are like, "Why don't we have an asset in Ahmedabad?" Right. So
Right.
that's then. I think tier 2 cities are coming up. I think only nuance is that the number of grade A offices is not as much as the tier 1 cities, and offices as sub asset class tend to concentrate in the top few cities, because that's just how
Right.
headquarters are there. People
Right.
migrate to large
Right.
cities. But other asset class becomes very interesting in other cities, right? Like
Okay.
warehouses you need everywhere, because
Absolutely.
there are people there. Schools you
Yeah.
need everywhere. Student housing you need everywhere, because there are universities in a lot of these tier 2 cities. So those are the asset classes I think will flourish a little bit more than your traditional offices in tier 2 cities. Because
Understood.
yeah, so I think it's more the other assets as opposed to offices in tier 2 cities.
Perfect. Shiv, I think that brings us to the end of the questions that we had for you today. From both Akshay and I just wanted to say thank you so much for clearing up
Yeah.
this still evolving field of fractional ownership regulations. And, I hope that we'll be speaking to you again for an update on this, much larger industry in a few years' time.
Yeah.
No, great.
Thanks again, Shiv.
Great being here. Thanks a lot, Yash. Thanks a lot, Akshay.
Thank you for checking out Concrete Conversations, the Indian real estate podcast. Check us out on Instagram for more short form content and highlights from our episodes. And if you have any questions, do comment on the video and let us know, and we'll try to answer them in an upcoming episode.